What's up guys, welcome to Money So Tasty. Let's all get a taste of capital. This year, 2020, is not a very investor-friendly year. So far in the first 3, 4, 5 months, we've seen a lot happening. So a lot of investors, a lot of fellows have been asking, can we still invest? And to be exact, can we still invest in the stock market? Should I invest in a fund, let's say a mutual fund, or should I invest in individual stocks, or should I just buy an index such as the S&P 500? Today we'll talk about what exactly is a fund, let's say mutual fund. What's the difference between a fund and a stock, and especially in the current market? At the end of the video, we'll also share with you how to best pick a winner fund and avoid the loser funds. We'll lay out some criteria that you can look for when selecting the fund. If this is your first time to our channel is all about sharing on your journey to financial freedom. What are the investing or money-making mindset you need to have? And what are the common pitfalls you want to avoid? If you want to become financially free with us naturally, then make sure you're subscribed to this channel, give us a thumbs up, and open your little notification bell settings so you will never miss another pie in the sky. Okay, first things first. In order to understand what exactly is a fund or a mutual fund, we need to understand the 3 traditional asset classes. I'm talking about cash, fixed income, and stocks. So what's cash, or sometimes we call it cash equivalents, basically things that are similar to cash. So that includes your checking account, your savings account. I know you probably don't think they're investment vehicles. They do give you a little bit of interest, which is totally taxable. And there's something a lot of people like and probably have purchased in the past called GIC, right? Guaranteed Investment Certificate. That guaranteed part just sounds so good. And then there's something that a lot of people encourage you to consider when you first enter the market or the fund market. It's called money market funds. So all those 4, so checking account, savings account, GIC, money market fund, are very similar. They are essentially cash or cash equivalents. Very low risk, but usually very low return. For example, if you invest now, it's probably just going to get you something close to inflation or not even at the inflation, which is usually 1.5% to 2%. So if you're not hitting that inflation mark, you are usually losing your purchasing power. So in essence, you're losing money. The next 2 categories we want to talk about is fixed income, or sometimes we call it bonds, and stocks. So a lot of people have been asking, what is the difference between a bond and stocks? So let's give you a little example. Let's say during COVID-19, you still go out and look for certain properties because you really need to buy a property. And you found this property and that you really like, and you want to put down, let's say, 50%. Right, I know it's a lot of money. I'm just giving you an example. Let's say the house is worth $1 million and you're putting down $500,000, and the other $500,000 is coming from the bank. So if you really think about it, it's the same thing as you and the bank together, you bought the property. Then here comes the question, who do you think has a higher risk if the property value drops? If you really think about it, you should know that the bank should have lower risk and you should have higher risk. And why is that? Because if the property value drops, the bank still gets its share of 50%, which is $500,000. So the real risk is the property value has to drop below $500,000 in order for the bank to make a loss. Whereas any loss before that $500,000 mark is a loss for you. So you are really the equity owners, or we call it you're owning the stock in this property, whereas the bank is just loan or debt or a fixed income. So now you see the difference. Fixed income in generally is a little bit less risky, but they also earn a less return. In this case, it will be the bank interest rates, which is usually 2%, 3%, 4%. Whereas you can earn a much higher return if the property goes up in value. So now we understand the 3 fundamental investing asset class, cash, fixed income, and stocks. Now we can talk about funds. The fund is really just like a cocktail of those three assets. So many fellows are asking, is mutual fund risky, or it is medium risk, or is it low risk? It all depends what is in the funds, right? It's the same thing as a cocktail. You have certain beverages, you have certain juices, and then you have some hard liquors. Of course, the alcohol concentration depends on the percentage of beverage or juices versus hard liquor. The more hard liquor you have in the cocktail, then you have a higher alcohol concentration. The more juices or pops you have in the cocktail, then you have a less alcohol concentration or lower alcohol concentration. That's the same thing with funds, right? The more stocks, especially high risk stocks, such as marijuana stocks, you have in the fund, the more risky the fund is. The more cash equivalents, and fixed income, especially low risk fixed income you have in the fund, the less risky it is. Now let's talk about how you can select the winner funds and avoid the loser fund. We'll lay out a few simple criteria you can look for when selecting a fund. The first thing you want to look for is fund size. It's not in every scenario that size matters, but in this case, size does matter. You want to look for a fund size of at least $100 million. Best to go with the fund size of over $1 billion. Why is that? The size tells you a couple of things. One, think about it. What makes up the size? The size comes from investor contribution or investor inflows, which shows investor confidence, investor qualification. It might also indirectly show that it probably has a good stability, good strength, and good track record. On the other side, what makes up the size is the gains over the years. So it probably shows that the fund is making money slowly and steadily over the years. Some other reasons why size matters is it usually brings more resources in terms of managing, researching, and operations, which can lower your management fees, and that can increase your return. Now, the second thing you want to look for is the track record. So how many years since inception? You want to look for at least 10 years. Best to go with 15 or even 20 years. Why is that? Because the financial crisis, or in general, the business cycle, the ups and downs, usually go in the cycle of 7 to 10 years. So if a fund has been established for 10 years, chances are it has went through a financial crisis. If a fund has been established for 20 years or 30 years, chances are it went through financial crisis 2 to 3 times. So now you can look at, during a financial crisis, how did the fund perform? What sort of strategies it employed? And what was the end result? And that can give you some sort of idea, the next financial crisis, how will the fund perform? And the third thing you want to look for is their investment strategy and their management team. So first, can you understand clearly their investing strategies? Does that align with your objective, your goals, and your view of the financial market? And then you can look at the management teams. How many people are on the team with different years of experience, in what fields? Do they have certain designations? For example, a chartered financial analyst. Okay, that's it for today, guys. Hopefully you have learned something about funds, mutual funds, stock markets, fixed income, cash, and cash equivalents. In our next episode, we'll delve deeper into something you probably overlooked, something you think it's super simple. GIC, Guaranteed Investment Certificate, and why especially so many business owners, corporations, and institutional investors, they all love GIC for different reasons. We'll explore that in our next episode. What is your view and thoughts on the stock market? Are you currently investing, or are you currently waiting and see? We'll love to see your comments below. If you have any interesting, insightful, inspirational, or funny stories relating to selecting mutual funds and investing in general, please share with us below. On our journey to financial freedom, we need to form some good habits. Why don't we start with the following 3 little habits? If you haven't done so, subscribe to our channel so you will never miss another pie in the sky. Give this video a thumbs up and share this with your friends and families, whoever you have discussed similar topics with. Money so tasty, retire so early. Until next time, remember, you are freer than you think.